Good afternoon and welcome to the Future of Finance Proptech meeting. I shall now pass you over to Dominic Hobson and our panel. Thank you very much.
Good morning to everyone. I'm Dominic Hobson, co-founder of Future of Finance. It's my privilege to moderate this think tank, I suppose we could call it, on how the real estate industry can find its way out of the potential crisis, which is being created by the global pandemic and its consequences. Now, the tumbleweed is not quite blowing through the Wall Street or the City of London, but office blocks, restaurants, coffee shops and city centres are certainly a lot less busy than they were even 6 months ago. Technologies such as Zoom and Microsoft Teams have enabled many employees to work from home without their businesses collapsing. Few of those employees miss their daily commute. Their managers have started to realise that many of those home workers are actually more productive and more conscientious than they were when they had to struggle into the office every day. In the early summer, the market cap of Zoom eclipsed the value of the airline industry. Last month, the £500 billion asset manager Schroders, which had just taken the lease of a spanking new office on London Wall, announced it would switch to flexible working from home on a permanent basis. So for investors and real estate managers and consultants, there's an important question now staring at them. It's, are we looking at a permanent structural decline in the occupation of commercial space in city centres, or just a temporary lull in demand? Now, working out the answer to that question means taking account of a virtually endless number of permutations. How easy is it for large commercial tenants to cut their rental bills? Will London or New York be hit harder than Luxembourg or Frankfurt or Los Angeles or San Francisco? Will social distancing mean companies rent more space rather than less space? Will a vaccine see a return to the status quo before the pandemic? What's the effect on carbon emissions if we use less public transport or lose more cars, perhaps? Does the economy need more but different space, perhaps smaller offices in regional towns? Does it need office space in suburbs? Will workers actually miss the social activity of the office? Are they dismayed by the blurring of the line between work and life? I could go on with questions like this. They're simply endless. But I won't go on because we've got 6 experts with us today to explore the future of the real estate industry. Sam Hocking is managing partner of SMH Analytics, which uses AI to interrogate masses of data to make predictions about the future course of real estate markets. Mohsin Masud is the founder and CEO of Tokenism, a Proptech dedicated to democratizing commercial real estate investment. Wesley Paul is a former portfolio manager whose company Gemini Analytics is a Proptech business that aims to help real estate owners develop smart buildings. Frank Spadafore is a former technology leader at Cushman & Wakefield, who now advises and consults with New York-based CRE Tech, which aims to help the real estate industry adopt technology. Professor Philip Trelevin is a professor and director of UK Financial Computing at the University College in London, which provides dozens of PhD students to work with firms on software and analytics problems. Frank Volchek is Global Director of Business Development at Invenium Capital Partners, which specializes in real-time pricing of digitized assets issued on blockchain platforms, including illiquid asset classes such as real estate. In addition to our panelists, of course, we also have you, our audience, and everybody watching or listening should feel free to submit questions at any time to any or all of our panelists. Simply use the Q&A. Many people seem to use the chat as well, but the Q&A is our preferred approach. We won't save those questions up to the end. We'll try and address them as we go along. So do please get involved as soon as you can, because we'd like everybody to be part of this discussion. Now, we're going to begin just by trying to set the scene as to what's happening in the commercial real estate markets. In the early part of this crisis, we saw the value of REITs crash. We saw commercial mortgage-backed security prices come under pressure. We saw property companies looking to raise debt and start to call on their banking facilities. But we don't really know much beyond some general observations at this point that the crisis so far has been very bad for retail estate. It's been very good in many ways for residential retail estate, and it's been, we don't know what impact it's had really on city centre commercial real estate. But I hope over the next hour or so we can start to shed some light on these and other problems. And perhaps I could come to you first, Frank Spadafore. You've been operating in the US real estate industry for a long time now. You've seen a lot of changes over the course of your career. What's your sense, anecdotally or otherwise, as to what's actually going on in the US commercial real estate markets now?
Yeah, I think there's a lot of anecdotal information out there about, population outflows, right? While multifamily has been resilient from a lease collection standpoint, a revenue standpoint, you certainly see central business districts affected. San Francisco, Forbes, Jack Kelly recently noted a 15.9% reduction in Bay Area rents, right? So even in the resilient property types, we are seeing some focal adjustments to underwriting to rent and yield expectations. Certainly on the office demand, Morgan Stanley ran a study across Asia Pacific with 3 to 9% expectation and reduction in office demand. For the US, we're seeing leasing activity in New York, Manhattan, down 25%. So there is some real anecdotal evidence of the impact both from population outflow and urban core demand particularly.
Mm-hmm. Thanks, Frank. Now, Sam, you're living in the heart of Silicon Valley, where the tech industry was born and where most of its innovations occurs. Is anything happening around you which you think is particularly noteworthy for the real estate markets right now?
Yeah, I think the things that we're seeing is migration and the contemplation of migration of employees. So one of the things that we had talked about earlier was what the audience might find interesting is the unintended consequence of telling your employees they do not have to come back to the office at a minimum till August next year, and for that part, maybe not ever. I think a lot of people are now contemplating or moving to secondary cities. And so if you think about the Bay Area, those secondary cities could be Salt Lake City, they could be Tahoe, they could be Bend, Oregon, Jackson Hole. And so lots of people are either moving or contemplating. And these companies are surveying their people, and their people are saying, whether they'll all act on it, 60 or 70% of their people are saying, we want to move. And we want to move to a lower cost environment. So what does it do? It requires these workplace solutions heads to think about, okay, if our people are going to move, are they going to move to places where there's other talent or other talent is going to? And in addition, then what kind of real estate needs would they have? Do we have to offer flex space? Because I think most of the companies we talk to do not think working from home is going to be the full-time substitute. They think it's going to be a supplement. So people might work from home 1 or 2 days a week, but eventually they'll go to a situation where at least 2 or 3 days a week they're going to the office. So these companies are having to think about, should we get this flexible space? What kind of needs do they have? So it's really becoming from an issue of, God, real estate is an important part of our strategy to probably the most important strategic thing they have to deal with is, where are people going to work? How are they going to work? Where are they going to live? And what do we have to provide them?
Now, Philip, perhaps I could bring you in at this point. You're in the business of manufacturing the kind of talent which Sam is talking about, albeit in the center of London rather than the Bay Area. Does any of what he said resonate with you? Are the young people, the young talent of the future, saying, well, this looks like a step change in where and how we work? We think we'll start thinking about moving somewhere else and taking our talent with us.
Well, the first observation is, yes, all my PhD students have also fled home or to the countryside as well. And we're able to interact with them just as well. I think the big thing to say is, surprisingly, we're big in obviously in AI and blockchain and things like this. Our student numbers have soared this year. Which is, if they show up, hopefully. I think that they're recognizing that data and analytics are going to be the big drivers going forward. So in Sam's area, so there's two things, getting the skills that they require, not necessarily interacting physically as they would do in the past. And the other thing that's actually very interesting is the rise in innovation, the number of students who want to actually get in to do startups and do applied research working with companies. So yes, the pandemic has had a big impact on on innovation and what the students are doing.
They're not yet thinking they'll go where the companies are, where the startups and interesting, innovative businesses they want to work with are relocating. It's just disrupting it at the moment.
So many students, particularly PhD students, are now trying to commercialize their research. And a lot of this is sort of data driven, including in the real estate area, that we've had to set up a new program called Conception X. If you want to look at it, it's online, to support them. In 18 months, we've gone to 100 PhD teams from scratch. And what we're seeing now is also, a number of professionals, looking to, get involved in startups and new ventures. So on the positive side, there's a huge amount of innovation, but we're now putting together startup companies with people scattered around the globe, Romania, Israel, Singapore, the US, etc. So some big changes in the last 6 months.
Yeah, I know we're a startup that's spread across the globe right now. We've got people in Singapore, Dubai, Pakistan, Netherlands, London, and across the US and Canada as well. So our team, all full-time employees are all over the world right now. It's definitely, it's changed the perspective for us, not having to have everyone in the same office. While we do maintain offices in the US, Netherlands, and one in Asia as well, but we don't have anyone going to the office anymore. And we're seriously reconsidering about what we need to do with that office space. So yes, for sure.
Do you think, Mohsin, this is a permanent change, that the people are expecting in future to work out of small towns or out of suburbs, because that has huge implications for the commercial real estate industry?
What we've seen is our teams, everyone working within our company, people have moved out of even a smaller city like Cincinnati. We're based out of Cincinnati, Ohio, in the Midwest. We're the 29th largest MSA in the U.S. So we're not quite as small, but still fairly small compared to any of the larger cities across the U.S. So we've had people move out of Cincinnati, all of our team members, more so because they know they're going to be working from home or from flex spaces. Like our CTO moved back to Netherlands to spend time with his family. Because he knows he's going to be working from home, and he's got extended family over there, just as an example. And I feel like this is going to be more long term of a thing with a remote work or having flex space access to work. That's one thing that we've done. We've been working with a couple of WeWorks kind of solutions. There's one called Food Collective, and they have a global network, and that's the best part with them. We've signed up all of our employees, and no matter where they are, what part of the world they're in, they have one close to them, and they're able to go in, and they're able to work out of an office if they need to, but it works out fairly well for us.
So Wesley, this might actually be good for the likes of WeWork. Does any of what Sam was saying about migration resonate with you?
Look, I think we've got to look at the reality of what's going on here. There are a number of long-term factors that have been in development for a very many number of years. And then we've now got COVID that in some ways has catalyzed some of those opportunities. So if you look at the trends in urbanization, the trends in technology, communications, better 5G, and all this wireless and all of these kind of capabilities, the impact of the pandemic has forced people to rethink what is a new normal. How can we work and continue to do what we need to do? And what they've actually found out is that technology exists that allows people to work in a distributed system. They don't need, if you don't need to be talking to people on a daily basis, and most of your time is spent in front of a terminal, then it's very easy for you to be conducting that activity from a coffee shop or from your home. And I think Zoom, any number of Teams, any number of these systems allows that to happen. But understand a couple of things here. It's the nature of work. We've been talking so far about office workers, but understand there are hundreds of millions of workers working in factories, working in the hospitality sector. They can't work from home, okay? They have to be in a space where they're customer facing, or they have to be in a space where if they're working in a hospital, they're dealing with their patients and so on and so forth. So the challenge that I see really happening now is people understanding the complexity of the nature of work. Some can take this easier step, which is working from home because I don't need to be with my team or I don't need to be with my customers. Those that can't have to go into their buildings and find a way to work in a safe manner. And what I'm seeing now is a huge amount of demand from all of these various verticals to look for ways to get technology to find solutions. And whether those technologies are there to identify social distancing using video camera technology, or to screen people going into a building for COVID, or to give them extra sanitization when they're in the building, or even setting up systems so they can queue properly at an allocated time to get into the building and use the elevators and stuff. This is where technology can respond. And to the exact question you had around WeWork and stuff like that, I guess what we're going to see is a little bit of a trend from urbanization to deurbanization, where you have more and more people deciding from not just a work thing, but from a lifestyle thing, that they're going to live in the suburbs or in a safer city. And as that process happens, the employers need to respond to that. And the employers are now, if you're an employer of any sorts, one of your biggest costs is your building, okay? And you want to have as many people in that building as possible to get the density right, to make the value attractive. So once you start making the decision of having distributed offices, first you've got the CapEx of finding them, buying them, if you're buying them or renting them, whatever, with the uncertainty of how long do I need them? So in answer to your question, I think companies like WeWork should be looking at this as a window of opportunity. But that's not to say that they don't have the same problems, because if WeWork wants to find a solution here, they have to find the buildings. They have to make the buildings fit for purpose. And then they need to be confident that they can get a rental stream from that asset for a period of time. And that reflects all over the place. So, yeah.
So real estate is not by its nature a particularly liquid asset class, is it, Frank?
No.
You're trying to make it one. But
and the other thing I really want, just as contextually for everybody, you know, the world is probably in the worst economic crisis that it's ever experienced. So uncertainty is everywhere. So if you're a real estate investor today, you've got where do I invest in real estate? So you probably want to own logistics, warehouses, cold storage, data centers, and stuff like that. But if you're an investor, you've got interest rates at negative or zero. You've got the stock markets that feel overvalued. And in relation to that, some of these real estate markets look actually quite cheap if you are a long-term investor, because prices have fallen and you could take the view that these markets will recover. So I always say to people, when you're looking at the investment, you've got the absolute return opportunity and then you've got the relative return. So with rates where they are, I think some yields in some real estate investment trusts are actually quite attractive where they are right now. So that's a different question.
Okay, thanks, Wes. That was helpful. Frank, you wanted to say something.
I was just talking about WeWork, in the flex space, because WeWork, it might be an opportunity for them, but they're a communal workspace where people gather together. So I think that that model will have to change as well. So they're going to have to rework they're going to have to rework that whole model of everybody gathered together in the center, having coffees, playing games, playing cards, the way that those offices are set up. We do use ServCore for our office space. and they are more of a segregated office type space. But to like what Mohsin was saying earlier, we can go into any city and we have office space available for when we have to have a meeting and we need a meeting.
Now, I'd like Sam and Frank to give us some views really on because we've been hearing, I suppose, that the distributed office, if you like, the temporary office, finding space wherever you want it, reallocating your staff to regional towns, villages, cities, and so on, and the real estate market being relatively illiquid. How easy is it going to be for the industry to adjust itself to that sort of model if it proves to be permanent? You know, if you've got, you know, it's a naturally illiquid asset class, isn't it? You've got long-term tenants in very large buildings in city centres. Suddenly you're dealing with a world in which you want to have lots of little buildings all over the countryside in regional towns and cities. And how hard is that going to be for the industry to make that change? Frank, perhaps you were nodding but looking quizzical at the same time, and I'm not.
Yeah, look, I think it's going to evidence itself in near-term expectations, right? On rental renewal probabilities, on short-term IRR and yields that are expected, right? I think to Wesley's point, over the long term, the fundamentals were strong. You're going to see some assets portfolios come on the market at a discount. So for investors, there's going to be long-term opportunity. You know, I think the shift around flex space, I think this goes back to one of the other points that Wesley made, right? Very dependent on the employee type. You know, if you look at the technology side, we've been used to a dispersed workflow, you know, digital meetings for years now. It's seamless, right? So I think there's a lot more mobility. But when I talked recently to my friends on the transaction side in brokerage, they've reinforced the importance of coming back into the office to complete deals. So yes, they have virtual tours. Yes, they have workflow that technology is enabling, but at the end of the day, to close those major deals, the deal teams still need to get back together. So I think the demand is going to be a function of the employee mobility, the distribution of that workforce, and their contentedness with working in a distributed manner versus those functional teams that might be more on the transaction side that actually are going to be demanding coming back into centralized office. So I think it's going to be a wait and see a little bit. Yes, I see some increase in flex demand, shorter term leases. Will that evidence in long-term you know, cash flow modeling over the full term of an asset? I think that remains to be seen.
I was speaking to some investment bankers earlier who made that same point, that the thing they're missing is those conversations face to face, which lead to innovations and authorize investments. Now, Sam, the data you're collecting, does this give our real estate managers, investors, consultants any guidance as to where they might start to place bets if Wesley is right, that actually some of these assets are starting to look quite attractive relative to everything else?
Yeah, well, there was a couple of things that I wanted to kind of share. Is one, I think for larger companies, they're not necessarily thinking about hotspots where their employees would go into communal spaces because they can't really do that for security reasons, information security reasons. So they're thinking more, just on that point, they're thinking more like we would have a whole floor. So people probably know this, but like Amazon is WeWork's biggest client, right? And Amazon employees are not going to go into a communal space with non-Amazon employees. So I think that's one differential people should think about, is larger companies that have big security issues are really thinking about taking own floors or their own space. And that's different than the communal. Yeah, I don't know if we're there yet on where the big bets are. I mean, I think I do agree with this point that, and I think that's why a lot of companies are thinking about making sure there is space, because there is this issue around either it's deal teams or it's tech teams that, you know, need to be together, particularly on the front end of innovation and the latter part of innovation where you're actually shipping product. It's really important on both sides of that coin to be together. So I think that's what they're driving people to make sure they're going back to work, or there's facilities where they can come together. I'm not sure clear yet where the bets are going to be made. I mean, I think we're probably in the middle of that and kind of looking at data and thinking about where should, you know, the bets made. I definitely think what's driving it. I mean, we've been working for the last year and a half on what are the secondary cities of the world. And we've been looking at performance on net operating income per square foot. And you can start to see, even before the pandemic, that there was a lot of drive towards secondary cities around where returns could really be made. And so I think the pandemic only increases that. The question that we have is it only short term yet? And I think it's just too early to determine that these secondary cities will for sure be, where you want to make bets. But philosophically, we think there's a lot of secondary cities that will get new investment.
Okay. Wesley, I know you want to say something, but Mohsin, you wanted to chip in on the commercial real estate investment opportunity.
Sure. Yeah. So from our perspective, as we're going out and acquiring assets and we're syndicating deals, we haven't really seen too much of that opportunity across the Midwest. So not on the coast, but across the Midwest so far, where the prices have dropped, or where we've actually come to a point where tenants are non-performing, and you actually get those good opportunities like we saw in 2008 and 2009, all the way up to 2012. We're nowhere even close to that right now. Having said that, I'm with Wes 100% in terms of real estate has to be a long-term play. It's not a short-term play. And with technology and the different innovations coming into the space, there's definitely a lot of real estate. Traditionally has been a very illiquid market, but companies like mine and there's a few others as well who are working rigorously to make it a little bit more liquid, to make it a lot more liquid, and to make it more affordable, and open it up to a larger group of audience than your institutional buyers only right now.
Okay, Frank Volchek, I'm sure has got something to add on that as well. But Wesley, you wanted to say something, but it's very quickly, because I'd like you to talk a bit more about I'd like to come to this smart office. I've got a little list of things here about what characterizes a smart office, and I'd like you to talk to us a little bit about that. But you wanted to say something about the investment side before we do that.
Well, not so much the investment side. I wanted to talk about what the drivers of change might be over the longer term as well. We're talking about reacting to a pandemic risk that could get fixed as we bring vaccines in. I think most people don't think we're going to have an effective vaccine for most of next year. But, if you look into 2022, people are going to be believing that we should be having some form or mix of vaccines that could help us. So if real estate is a long-term asset investment. So if you're just looking for a period between now and the beginning of 2022, then people will wait and they'll buy. And you'll find that people aren't going to be, looking to be too worried about selling or making big changes until they see a little bit more clarity on where the solutions might be. There's some very big issues as well in the background, like climate change. So in some areas where you've got cities that are located in areas where the summer temperatures are now 40, 45 degrees, or in the Bay Area where you're getting red skies at night for fires, or in places like Delhi or in any of these other countries where you've got high levels of pollution. The buildings themselves are becoming the sanctuaries for human habitation, whether it's during work or whether it's during play. And the buildings themselves need to adapt, to adjust themselves, to be able to provide the environment that controls air quality, that puts more chilling into the building than maybe heating. And if you look at this at a global level, the building stock around the world, commercial real estate is about $32 trillion. About 0.5% of that is considered smart. So to the question you're going to ask me in a minute is what constitutes a smart building? Well, I will tell you, most buildings seem to be occupied by Luddites who have rejected technology for many, many years. And this is a moment in time where I think they're going to start to believe that technologies can provide solutions. So we're probably going to be on a journey now where the average building, remember, you look at Europe, some of the buildings here are 500 years old. They're not 50 years old, they're 500 years old. So how do you adapt a building like that, keep it fit for purpose, and then, of course, maintain its value?
Okay,
The
now,
only answer has got to be tech.
let me ask you, you made a very astute point there that, of course, air conditioning opened up whole new real estate markets in the southern United States and Singapore and indeed India and elsewhere now. But if we look at let me read you my list of smart technologies for offices. It's access checks and controls, like a temperature check on people. It's having more space per employee. It's having sensors in the office to make sure the social distancing is being maintained. It's having physical barriers, touchless elevators, coffee machines, voice operated equipment in the canteen, regular cleaning of shared equipment, lots more vending machines, staggering entry and exit from the office so people aren't, the lift isn't getting crowded on entry or exit. Maybe you issue staff with immunity passports. They've had the virus or they've had a vaccine or whatever. You need pathogen detectors, you need pathogen killers, you need hygienic bathrooms, you have robotic cleaners, and you have maybe holograms, so people can have some of these physical meetings while not actually being physical. There's a whole string of things, but most of these seem to me to be directed towards trying to rescue the system we have, as opposed to trying to propel commercial real estate into the future. Is that a fair characterization by me? This is a rescue plan, not an innovation plan.
Yeah, this is you're correct, and I think a lot of those things you've mentioned are technologies that make assumptions that this pandemic is going to be with us far longer than we are expecting it to be, that behaviors are going to change. On issues like hygiene, for instance, there's this issue of personal hygiene that we keep talking about: wash your hands, wear your mask, and everything else. But the issue now is when you go into an office, you want to see that the people you're working with are also observing the same levels of hygiene standards that you have, okay? So all of a sudden, you've got this mix of very stressful activities where not only are you having to perform differently, sitting all day with a mask on, but when someone comes to talk to you and they come too close to your desk and they're not wearing a mask, what is the social behavior to say, back off, stop, or whatever, and so on and so forth? So people have to go through a learning process here to accommodate that. Technology can do a lot of things, okay? And we've heard through the years about Industry 4.0, where you want technology to be modular, interoperable, real-time, virtual. But at the end of the day, technology needs to recognize it has to be human-centric. We are the users of technology, and therefore we adopt technology that we believe in and that we trust. And if we don't believe in it, if it doesn't work, if we don't trust it, because we think our information gets leaked or whatever, we won't use it. So all these people building all sorts of clever technologies, it's frightening. I'll give you a good example. Let's talk about detecting COVID in the air in a building. Well, this sounds like a brilliant idea, doesn't it? But what happens once you've detected it? What's your responsibility as the building owner that your system has flashed up and said, it's detected COVID inside the building? Do you now evacuate the building? Do you therefore shoot yourself in the foot? Okay, because you've now basically made your building redundant for a period of time. And what is your responsibility thereafter to sanitize the building? How do you locate where the source was? Now, the likelihood is the source of the COVID detection was an individual, okay? And therefore, you've got all of these new challenges that, first of all, they didn't exist before. And the question a lot of people are asking, are these semi-permanent or permanent changes? So we can do things, we can use AI, we can do pattern recognition, we can do all sorts of clever things. But at the middle of this, in the center of this, is the human being. And humans need to adapt to this. So I would say to you, technology is great, but it's got to work in a operating context where people, by the nature of them going into an office for the moment, it's about working together.
Okay, thanks, Wes. Now Frank's metaphor. This is your area. You've heard Wes say there that technology doesn't solve the problem, but it does change the nature of the problem. And you have to have technology which works with the grain of human nature and not against it. What are you and your clients thinking and saying about the new technologically equipped office?
I mean, I think that's spot on, right? Because it's outcomes based. And when we look at smart buildings, we tend to broaden that definition to mean connected buildings. And that can mean a lot of things, Dominic. You know, if we look at just straight building performance, we have now 5 or 6 years of real evidential data, empirical data that shows that building information systems, building automation systems, right, energy management systems are returning a 15, 20% reduction in energy utilization, right? So when 60% of your built world cost is on utilities and energy, reducing that by 15% on a specific asset, that's real ROI. So smart connected building technology has been progressing over the last 5 years, really, where we've seen that kind of traction, where it's ROI driven. You mentioned some of the things that I see as more reactive on how can smart connected buildings help with reentry for COVID. So touchless access controls, occupancy density monitoring, of course, but connected buildings in general are offering many more advantages, and you can see that in the design and construction industry. So BIM and building information modeling, right? And the way that that's increasing efficiency, reducing rework, reducing liability and risk exposure. That is all about digitizing, virtualizing the asset, and then collaborating around that connected building. So Dominic, I think it's broader. It's tenant experience, right? Because that drives rent premiums, that drives your tenant experience per square foot. It's connected buildings for performance. And then it's also all the things that you mentioned that connectivity gets you in increasing standard operating procedures for COVID reentry.
Dominic, can I ask you a question?
No, I'm the moderator. I ask the questions.
Okay.
Go ahead. You can try me, but I don't know much.
No, it was a general question. We've been all talking about repurposing buildings, but at the same time, we've been talking about augmented reality, digitization. Is there any trend towards, take Zoom to its extreme? We could have a virtual building where, in fact, we don't need a physical entity. Is there any? I know less about your area than anyone, so that's why I wanted to ask the question. Is there any thoughts about do we need buildings? Could we just do it all by taking Zoom to the fun? Yeah, by hologram. Thank you.
Well, Frank Spadafore, I think that's a serious question in a way.
Oh, shit.
And doesn't sound
question, right?
Doesn't sound great for the real estate industry, but maybe the industry morphs into a purely digital, becomes a virtual business.
Look, I don't know. That to me, that would be speculative to say what's that long-term demand reduction going to do. I can say that looking at traditional ways that we're interacting with buildings, the digital twins technology is the culmination of that, right? Where now your virtualized operations, your fault detection, preventative maintenance, tenant experience, all onboarded to a central digital model of your building. So that's possible. But, Philip, I'm not sure what the long-term demand for that physical space would do to that virtualization track that we're on.
Mm-hmm. Well, could we perhaps get Mohsin and Frank Volchek to give us a view on this? Both of you are involved in your different ways in trying to make real estate more liquid, more democratic, if you like, since it tends to be a pretty chunky investment as well. Are you having any even speculative conversations about the virtual office? Mohsin, you go first.
I'll let Frank go first. That's fine. No worries. He's about to start talking, so.
Was he? Sorry.
Yeah, well, I was just gonna say, from Invenium's viewpoint, what we're trying to do is collect all of the data that would be produced off of a smart building, and any data that we can take, so we can digitally certify that data. We can index it and field it so it's high functioning, and then we can relate it to other models. So, and through that process, we've been able to find that we're able to move assets from a level 3 to a level 2. So it changes the way that it sits on the asset owner's balance sheet. So we can create some capital release in the form of reserve requirements. We can also that's where we are. So we haven't really looked at the virtual space yet, but we haven't touched on this. What we haven't touched on in this conversation is productivity of the workers that aren't commuting now, that are really working virtually. And I've talked to a lot of different people from the banking industry and from other industries that they are finding that the workers that they have working virtually, they're getting a much higher productivity rate because they're not spending as much time commuting. And for that, they feel that there's part, like Frank Spedafora was saying, part of their workforce, they would like to remain virtual because they're getting a high productivity rate on it. But there is a part of the workforce that needs to be centralized, that needs to come together and needs to interact for the closing of deals and for other technology pursuits.
Okay, so, but Frank, could we just stay with your earlier observations about collecting data from smart buildings and being able to raise the quality of the asset? You better explain to our audience what going from level 3 to level 2 actually means for your balance sheet. Just make sure everyone understands that.
Well, it's really they're just accounting. They're basically accounting standards. The way that a level 3 would be an illiquid asset, a level 1 would be a REIT, a level 2 would be a market alternative. And by taking what we do is we take unobservable inputs and we can make them observable. And by doing that, we can move that from a level 3 to a level 2. So for a big insurance company that owns real estate or invests in real estate, we can change their reserve requirement from 20% to 10%. So on a $500 million asset that they own or that they invest in, we can take that reserve requirement from 100 million down to 50 million. So they have that's a big capital release for that company, which they probably could want to see and can use right now. So we've seen a high demand of interest in what we're offering right now. We are still a startup company. We're a startup. We're working with a lot of names in the industry that you guys would know. And I've worked with Frank Spedafora on this for a while. He knows about Invenium. He knows what we do. He's been consulting for us. And that's what we're trying to do. We're trying to create some capital relief for the asset owners. We're trying to open up the avenues open up the communities of the people that have the ability to purchase these types of assets. We're trying to democratize it in a sense. We don't think it's mom and pop and the accredited investor are going to be the buyers of this, not for a long, long time. But we look at this as a data play rather than just a fractionalization and distribution play.
So tell me, how does collecting all this data from a building, a smart building, make its value more reliable and more liquid as well, make the asset more liquid? How does that work in practical terms? What are you finding out?
In practical terms, when you're looking at investment, when you're looking to invest in a commercial real estate, there's legal, there's financial, and there's operational. And the technology, the Proptech technology is the experiential side. So we are, I'm sorry, somebody just texted me and I fell off for a second. I apologize, because I'm working from my phone. So we feel that this is, what we're trying to do is collect this data, is make this data, take this data and create a provenance for this data so it can be trusted and other people and can be socialized. So in order for people for people to make investments in these types of assets, they have to trust the data that they're seeing. And that's basically what Invenium is focused on, is data provenance and socialization of that data so that people can make intelligent investments. And we think in the future, the refurbishment, to what Wes was saying, that only a 0.5% of the global real estate buildings are smart. We feel that the refurbishment of these commercial real estate assets isn't people going to come in and going to change their, upgrade their bathrooms and upgrade their countertops. What they're going to be doing is they're going to be making their buildings smart, so that people can know what kind of traffic do we have in here, what kind of footfall, what kind of key fob data is there, toilet flushes, heat. Like Frank was saying, there's a 50% savings on utilities now. There's empirical data that shows that. So what we're seeing is we're going to be able to determine from the data that we're collecting what are the most investable assets, what are the assets that are losing value. When assets are compared today, certain assets are compared. There might be a capital call on one asset that doesn't really relate to yours as far as all the data that's flowing out of it. But you might have a capital call on your asset because it's just related. It's in the same relationship. What we're trying to do is be able to go take a deeper dive into all of that data to really determine what the value of that asset is.
Great. Well, Sam, I'd like to get a view from you in a minute on whether that data is useful for what you're trying to do. But Mohsin, what are you doing at the moment to make real estate more liquid?
Right. So what we're working on is purely fractionalizing real estate, and what we're offering it in terms of smaller fractional ownership. So a little bit different than what Invenium's doing, and we have a different perspective. We are offering it to accredited investors, and we want to open it up to a larger market as opposed to still the existing market. So we believe we're adding the liquidity in the market by having a significantly larger investor pool in play, and having the ability to invest in some of these commercial real estate assets. Having said that, data is absolutely key. Smart buildings are absolutely key, and we're working on something similar to what Frank said, but a little bit different. We've got whether it's smart buildings, it's IoT integrations into assets that are going on our platform. It is an AI engine that our engineers are working on developing for processing that data to get all of that information to the end users, to the insurance companies, to the underwriters, for getting better value out of those assets as well. So smart buildings are key, are essential. It's just 0.5% of the buildings that are smart. That number is going to change very, very quickly. Post-COVID, you will see much. It was already happening. It's not that COVID's kind of brought that change to it, but it's going to make that change a lot faster. Where anytime any building, one of the first few changes that would happen to them would be these smart aspects added, whether it's door access, and therefore now you have access to data analytics, data from the key fob entry, for instance, as Frank said, or it's even more detailed in terms of utility management or maintenance management or preemptive maintenance. And Proptech has a lot of its partner companies who are currently working on this, and we've looked at a few of them. So and we're partnering up with a couple of other companies as well who provide those solutions to get the best product out there for democratizing the real estate aspect to it.
Thanks, Liz. We have about 10 minutes left now. I'd just like to get a thought from Sam on whether the toilet flushes in buildings are finding their way into your data set. I'm trying to work out what's going on here. Then I'd like Frank maybe to summarize what smart building is going to do for us. So Sam first.
Yeah, so I mean, when we look at data, we're agnostic to the data. So we'll take any kind of data. So we look at proprietary data. So we look at transactional data. If we want to look at behavioral data, which I think is really important, the behavioral data could be key fob data, how people are going in, how much energy they're using. We use all that data. We also use subscription data, and then we probably have 100 other data sets that are alternative data that we're trying to figure out what are the drivers driving the cities that could then drive performance of real estate. So for us, all that kind of data is just more input into kind of our models that we build that then build predictive analytics on different measurements.
Thanks, Sam. Now, Frank, could you just sum up for us what the smart building is going to do for us?
Yeah, I think in the short term, Dominic, the asset managers are really the ones that are driving alpha in this space, right? Because if you look at smart connected buildings, you're seeing rent premiums for tenant experience, right? Where you have centralized communication, amenity scheduling. So from a tenant experience, there's premium in the rents. From an asset manager performance standpoint, you've got energy management systems, building automation systems that are driving performance saving. Performance alpha on these assets. I think the longer tail is how does this translate into pricing, right? Because eventually my thought is we're going to be looking at buildings and understanding, do they have an operating system? And that's going to drive lower cap rates, right? Because we know that a building OS and building automation is going to drive those energy efficiencies at a minimum, right? Until then, so what's the tail to that, Dominic? I think some of the proxies are going to be good for pricing and for competitive set analysis. So we already have LEED certification, right? And you know that rolled up in LEED credits, you have some of these underlying performance interventions that are driving those certifications for LEED. I think we're going to see similar things with, there's a company called Wired Score. And Wired Score is rolling up a lot of these concepts of smart connected buildings, and they're coming up with certification levels for assets, right? So I think until we can get very granular on, as Sam said, what are those new signals, footfall, mobility, tenant satisfaction that are driving actual correlated value premium? Until then, we are likely going to have the asset managers really driving alpha for smart buildings. We're going to have these proxies for a competitive set. Are you LEED certified? Do you have a Wire Score, right, for your building connectivity? And then eventually, to Sam's point, we'll start to be able to correlate some of these new data signals to real pricing premium.
Thank you, Frank. Now, we're entering the last 10 minutes or so of our discussion. Now, Wesley, I know you wanted to come in on this last issue, but I wonder if I could tempt you instead to lead us into the final part of our discussion, which is to go back to the question I had at the beginning. Is this a step change in the nature of the commercial real estate markets, or is it just a, as I think you were saying earlier, wait till 2022 and life will be recognizably normal again? Is this just a temporary lull, perhaps, in the way the market operates? And if it is a step change, does it owe more to technology or more to this pandemic, or to both?
Well, that's sort of the million-dollar question, isn't it? And let me answer it this way. There are longer-term trends going on that are creating continuous change. And I think what we do through time is we oscillate around those longer-term trends. So what we think is a normal is actually a continuous change that's happening. To answer your question, I think human beings have a short memory for pain. They swing from greed and fear very easily in financial markets, and they'll forget when they've lost money. I've had customers at JP Morgan say, I'll never invest in a certain thing again. And then 3 years later, there they are, bang in again, fully loaded. So the reality is, I think this will be transient. It's probably going to be replaced by COVID-20, COVID-21, but we'll learn to cope with it as humans do. So I think to the question you've got is, we should examine what are the bigger changes going on that might continue to, if you think about it, affect what I would call trend, as opposed to volatility around that trend. And one of the things that we haven't really talked about is climate change here, and the impact of what regulators are going to do. And I think in building certification, making a connected building smart with a lot of technologies that are all producing higher quality data so that there's more transparency and it creates that liquidity that we've been talking about from the 3 or 4 previous speakers. That's all great. But regulators, certainly in Europe, and we're seeing it in several countries in Europe, are ready to impose pressures on building owners to comply with energy reductions to reduce their carbon footprint. 30%, actually it's closer to 40% of carbon in the atmosphere comes from the built environment, whether it's in the cement production, the building of the building, or the actual operation of the building when it's finished. And therefore, any commitment to produce, by 2030 or 2050, or as you've heard from the Chinese at the UN this week, by 2060 to be carbon neutral. If you are committed to that as a government, if there is consensus around G7, G20, or whoever exists in the future, they've got to attack the technology in buildings that continues to reduce the impact buildings have on the environment. So they will have to become smart. They will have to be connected. And by the way, this idea of being connected is having IoT, having AI, machine learning tools, all of these things working in concert together to extract as much information and knowledge about devices and so on and so forth. But also, and this is another point I wanted to make, to understand what's going on in the immediate environment around it. So one thing I see happening in the future is we get community-based solutions, smart community-based solutions, which could be district heating, district cooling, or district energy generation, that actually reduces the workload in all the buildings in that community, so that every building doesn't have to go through the invasive changes they may need to do to get more chilling capacity or whatever. So this is a moving feast. It's going to affect real estate values. Real estate represents about $240 trillion worldwide, including residential. That's equivalent to all the bond markets and all the stock markets pretty much put together. So it's a huge real estate market, and it's going to keep going.
It's a big industry, it's a dirty industry, and its future possibly lies in operating at the local level. I like that idea of local energy grids, local cooling grids, etc. We're down to our last few minutes, so perhaps I'll just give each of you a chance to say something. And I'll start with you, Mohsin. You heard Wesley say that human beings have a tendency to forget. You're committed to this market. Is that a useful thing to know right now? Have we forgotten what happened in the past with pandemics?
Yeah, that's exactly it. Us as human beings have the nature to forget as what's happened in the past. You can go as far back as the cholera pandemic in New York, or you could go look back a little bit earlier, a little bit closer to our time at 9/11, where there were rumors of no more skyscrapers or whatever, and people were stressed about it and whatnot. But we have this amnesia which comes into place, amnesia of convenience, rather, where you will see people forgetting about COVID-19, and as Wes said, there would be COVID-20 and COVID-30 or whatever it may be in the future years, and it could be any other thing that's affecting it. But we will move on. Us as human beings are much more resilient and very easily forget some of these things very, very, very quickly as well. So what we're looking at right now is transient. Or can we take the advantage of it and utilize it to the best interest of our communities, of our development? Yes, and that's exactly what we're seeing happen right now. And we've all been talking about smart buildings and how much it's accelerated the process so far. Whether it is no touch environments, or it's IoT in terms of utility management, or it's data management, or anything on those lines. So yeah, it's transient. People forget very quickly, and moving on in the future, I don't foresee this being as a very long-term issue.
Thanks, Philip, perhaps a last thought from you. Is digitization about to do for the real estate industry what air conditioning did for Texas, or is it about to do to the real estate industry what the internal combustion engine did to steam power?
I think in the short term, data is going to be the big thing for the smart building, and that's very clear. The way things are going, I think the idea of virtual real estate and being able to put together teams, or companies, across the globe dynamically, that could be a big longer term trend.
Thanks, Philip. Frank, Moltek, you've just heard Philip say data is going to be the thing that matters going forward. That must be music to your ears.
Yes, it certainly is, because we're based on data and the provenance of that data. So making that data trustworthy, making it sociable, and transparent. So as the market progresses, and as we open up these markets to different types of investors, which is bound to happen, which is going forward, and the digitization of all these markets, I heard your analogies before, Dominic. I would also like to add the analogy. I've heard people that they refrain from even thinking about digitization because it's like them betting on candles when electricity's coming. So I feel that data is going to be king, and that's the premise of Invenium is gathering that data, providing provenance to that data, indexing and fielding that data so it's sociable and it can be applied to all different types of models, whether that be a pricing model or any type of human activity model.
Sam, give us a vision of data in the real estate industry in 2 or 3 years' time.
Yeah, so we've been working in data around AI and machine learning for the last 10 years and productizing it. I think one of the biggest challenges is data gathering for data gathering's sake is a very challenging task. So I think the key around real estate and data is what are the targets? And when we've run really well, it's like we have a real target and we have a real outcome. And I think the key in the real estate is what are the outcomes you're really trying to get from the data? Because if you don't do that, it's just a lot of data and you're not really finding where the signals are. And the key is to find the signals and the drivers to the outcome.
Well, we've had a comment from one of our listeners, exactly, nature-oriented, carbon-neutral buildings, energy-producing buildings. So what we've said has resonated with somebody. Frank Spatafora, I'd just like to give you the chance perhaps to wrap up our discussion. You're at the center of everything happening here. You know the old world, you know the new world, you know technology, you know data. What can we look forward to in the real estate industry if we look forward beyond this pandemic to what the industry is going to look like by, say, 2025?
Yeah, Dominic, for me, it's actually preceding COVID even. It was a really exciting time around convergence. And I heard something from the CEO of Oxford Properties recently that resonated with me, that the three main drivers, right? Triple bottom line, people, profit, and planet. And I think, as Sam mentioned, and Frank Walczak mentioned, underlying this data and the signaling collection of the right data that's outcomes based drives all three of those goals, right? Those drivers, people, profit, planet, they are not mutually exclusive. They actually have shared interest. And if we can unify around the data that drives commercial real estate, there's opportunity to deliver on all three of those drivers, right? So I think when you start with the design and construction phase, all the way through asset management and investment alpha and finding that premium for your assets, it is all data driven. So the more that we unify on the data model, the data standards, and we are able to meet those three drivers simultaneously, I think it's a pretty exciting time around that convergence.
Thank you, Frank. There's a great note to end on, the three Ps. Sadly, we are out of time now. So I'd like to thank you all. Thank you, Wes. Thank you, Sam. Thank you, Philip. Thank you, Frank S. and Frank W. And thank you, Mohsin, for joining us. I have a sense this discussion could go on for many hours yet. And I look forward to returning to it with you in the very near future. So thanks for taking part. And thank you also to our audience for listening to us. I hope you found it interesting and valuable. And we look forward to seeing you, or maybe not seeing you, but certainly hearing from you at our next Future of Finance webinar. Thank you and goodbye from the 6 or 7 of us.
Thanks, everybody.
Thanks, everybody. Thanks for joining this. Bye-bye. Bye. Thank you, Dominic, and thank you to our panel. If you would like to see the summary of this discussion, please visit our website on www.futureoffinance.biz. And indeed, if you would like to see the video again, that is also on our website. Many thanks.